Your camera's not on, Mike.
Hold on.
Okay, let's roll, people. You ready?
Go.
Hold it, Mike. Why does your background look so weird?
It's blurred.
Okay, okay, that settles it then, I guess.
Because I can't do the green screen thing, so it's blurred.
Okay, good. Welcome to another edition of the Futures Edge podcast. I'm Jim Uriel. As always, brains behind the operation, executive producer and co-host Bob Iacchino. And today, the first Friday of every month, we have our technical guest. Today is co-founder, chief technical strategist of Path Trading Partners, Mike Arnold. But Mike, today, again, I love when you're on the show because I learn a bunch of stuff that I hadn't thought of before. And everyone, Bobby and I both fancy ourselves as technical analysts as well. And when you talk to someone who that's just what they do, and they have their nose in that every day, you learn things because everybody does things different. Technical analysis is an art, not a science, and Mike is an artist. However, today we're going to spend the first couple minutes talking about some fundamental, Mike, I'm sure you've heard of it, fundamental analysis, because today we had the unemployment number today, which came in a startling 538,000, leading some to believe that the recession has been forestalled. Put a sell into the stocks because of the belief that the Fed is going to be more emboldened in their raising rates. Bobby, what's your main takeaway from that number today? Was it anything that it just confused the hell out of me?
Yeah, there's a couple of things I want to point out about today's number. First of all, I got a lot of people, friends of mine on the political right, who said that number has to be fake. I never liked taking that tact, right? Because to me, it's like, well, I'm sure the left said numbers were fake when Trump was in office, and then the right said it when Obama was in office. One of my buddies called me up and go, hey, they got Obama's guy back in the BLS, because it's impossible that jobs were added if there's a Democratic president. But so first point, that's the number. We always have the data that we have, and that's it. It could get revised lower. It's unlikely that it's going to get revised negative. It's unlikely that it's going to even get into the two handles, right? It's probably not even going to get revised down to 200,000.
So are we not in a recession then?
Well, the biggest revision I've ever seen is 90,000. I've never seen any bigger than that. So I guess it could happen that they make it bigger. But even if it's 90,000, then it's 438,000 jobs. And that's still a huge beat. The recession point of it. I've made this point before. I don't care if we're in a recession or not. Stocks do well during a recession. They have a positive historical return during recessions. The only times that they don't is when inflation is involved. So stagflation. And I feel like that's the more important conversation, and people aren't having it. They're arguing about what the definition of a recession is. The NBER has been basically saying when a recession began and ended since 1978. I don't know the year that they became the official, like, was there actually a proclamation, an executive order, a mandate by Congress at the NBER? I don't know when that became the thing, but it's been the thing for a long time. I was taught it's 2 consecutive quarters of negative growth. Jim Bianco pointed out on this podcast, we have had recessions without 2 negative quarters of GDP growth, but we've never had 2 negative quarters of GDP growth and not had a recession. This could be the first time that happens. It depends on what the NBER says. So we can argue about the definition of a recession, but I'll tell you one thing, stagflation, argue all you want, it hurts. It hurts stock prices, it hurts consumers, it hurts everybody.
Well, that's kind of my point. When I saw the number today, like this is an unusual time that we had unemployment on Friday, and then now that CPI is absolutely by far the biggest number after the last 2 prints. We have that on Tuesday. So why would we give that huge of a reaction today? And again, we made a lot of that back. The stocks rallied a little bit toward the end. But why would we have given it all away before we see the CPI on Tuesday? Meaning, by the way, I challenge you, and I think it's bipartisan, perhaps, fudging the numbers, but I think it's certainly possible to think that the government does. I know we've disagreed on things before, and I'm not saying the Democrats do or the Republicans do. I'm saying both probably, again, when all the power in the world is at stake, sometimes malfeasance happens. But anyway, the point is that if we see a great number today, which essentially was a great number, except for a couple different parts of it, one being the participation rate dropping. I know you saw that 63,000 people left the workforce, which I don't have an explanation for. But aside from that, it was a great number. If we see a great number and then we see a 5 handle on the CPI number, which is much lower than expected, then that's not the end of the world. It means things are going in the right direction. So why are we selling the stocks before we see the far more important shoe to drop? Do you agree with that?
I do agree with that. And the one thing I would say to that is the stock market sell-off, the reaction at least, because as you said, it came back in toward the close. The reaction was based on the idea that they now believe the Fed is going to continue to be aggressive. I would argue that there has not yet been a reason to think they're not going to be aggressive. Okay, and here's why. They have a dual mandate. We saw this week that Andrew Bailey, the Bank of England governor, said, we're going into a recession. And everybody was like applauding the bravery of the UK central bank. But the UK central bank does not have an employment mandate. They don't. They only have a price stability mandate. Same with the ECB. The Fed has both. So strong labor means the Fed will be more aggressive, not less, because they need to control inflation. Now, Mike pointed this out to me during one of our live streams on Path Trading Partners. Bank of America put out a piece that said, even if every month over month CPI number was 0 going through the end of the year over year would be 6.3%. So it's a fantasy mathematically to think we're going to get down to the 4 or 5 handle this year, because I don't think there's any way in hell we get a consistent batch of 0% month over months going forward. So some of these things are just math. And the thing that I keep trying to point out to people, I must be wrong, because everyone goes, yeah, you're right. And then they say the same shit again. CPI is an index. And the example I like using now is a car. Okay, in 2020, a $35,000 car now costs $38,150. Okay, because there was inflation in car prices. Consider that car to be the CPI index. Inflation in automobiles was somewhere in the range of 6.5% over that time period. If that goes to 0, you're still paying $38,100 for that $35,000 car. If it goes to 0.5%, you're now paying $38,180 for that $35,000 car. The prices stay up. So even if we get good month over month or year over year inflation numbers, until they go negative, prices are where they're at. That's why, back to the non-farm payrolls number, the wage component was the biggest deal to me, because the wages need to still rise in order for people to catch up to the inflation that outpaced them and is probably at least staying where it's currently at.
Right. And I like what you're saying, because inflation doesn't mean that prices are high or prices are low. Inflation is the rate of change of those prices. And it is a difference. The rate of change will stop, the price won't go down. I'm in the restaurant industry, Branch Palatine, we have to plug at each show. It's in my contract. sorry to enforce my contract. But we are not going to lower prices if our supply costs come down, because we don't know when the next shoe is going to drop. And we've had lower margins for the last year. Why would a restaurant ever just go, oh gosh, we're getting a better price on beef now, let's pass it immediately along to the customer before we figure out what's going on? We just won't do that.
You've had some wage increases too. My brother owns a restaurant as well, and he told me that his employment costs are up 33%. And he's not going to go to those people and say, by the way, we need to cut your pay because prices have come down.
Right. Exactly. It's amazing. So let's get to Mike and let's look at a technical analysis of this, and we can maybe pepper it in with some of our fundamental thoughts as well. Again, I know I introduced him 10 minutes ago, but Mike Arnold, co-founder and chief technical strategist of Path Trading Partners. Thank you, Mike. What do you want to look at first? You want to look at stocks?
Sure. We can look at stocks.
So we've had you on a couple times before, and this is someone I look at technical analysis all day. Your level is high, and sometimes I think I lose you when we talk about your process. Do you think we could throw in some building blocks of your process in our first charts here, and then go forward from there?
We can throw in whatever you would like, Jim.
Thank you, Michael. I appreciate that. Good. I'm never the boss anywhere, so I didn't expect to be here. You should go to my house. But anyway, so let's put up a chart of. Let's just start with the S&Ps. Let's start with the what everyone wants to look at. And
All right. Do you have my chart up?
We do.
okay, so you got a lot of lines. By the way, the colors look more vibrant. I wonder.
It's very crisp.
Good looking. It's very crisp. I'm excited about this chart.
Well, my major streaming computer died a horrible death 2 weeks ago. So,
Really?
so I'm on a different streaming computer.
Looks fabulous.
This one's actually older, so it looks better because it's older.
Hey guys, I had a request to make every podcast a drinking game. So what should be the word today?
I got nothing.
I'm just gonna say stop level.
You want to hear something funny? Something really funny. As long as there's dead air, and I don't like dead air. I was getting dressed. I was in my health club, and I was like thinking about do my hair, come and makeup. I was like, oh, it's just Mike Arnold's a guest. I don't have to look that nice for them. And I was like, as I was walking away from the mirror going, oh yeah, other people watch this too, by the way. I totally forgot about it. It was just, to me, it was just a conversation with Bobby and Mike. So I'm sorry about that. I will try to look as nice as I can.
Actually, you know what's funny about us not being able to figure out a drinking game here? It's like three dudes. We're used to just drinking.
Yeah, we just shut up and drink.
I don't need to make it into a game.
And then bust each other's balls. Okay, Mike, let's start by taking all those lines away to describe your process as we put them back in. How's that?
All the lines away. All right, we'll take all the lines away.
Well, not the ones that say the price, not the ones that you didn't put in. Okay.
I'm not hiding the price.
So there's all the lines. Let's build this.
Okay.
By the way, did S&P traded up to 47 on the close? Okay, good.
We're 41, 40, 48 right now going into the
49 trade. That's where my sell level is. I have some futures there. So somebody out there buy those. Anyway.
You're probably gonna hit that in the next 2 minutes. So
good. Been a good trade.
Nice little rebound. So the first little building blocks, the first thing I like to do is put on what I consider the rotation zones. Oh, hold on. Let me get the rotation zone. All right, those and which are made up of moving averages. Okay. Why do I like to do that? Because I can glance at things really quick and know what kind of overall market I'm in, and some key levels that test out because a lot of people follow them and have had historical testing. So I put up the orange line or yellow line is an 8 exponential moving average. The blue line is a 21 exponential moving average, and that comprises something I talk about called the rotation zone. The other lines I put up are the 50 exponential, which is always green, and the 200 simple, which is always red.
Now, I'm going to stop you for a second because if Jim doesn't ask this question at some point, somebody else will be asking it watching this show. And I'm going to answer it for you. Why those particular numbers and why exponential over simple? Because they tested out better when Mike looked at them. That's always the reason.
If you ask why I do something, it's because it tested out with higher probabilities. For example, in our bull markets, what do I watch for when we're in a bull market? It would be a pullback between the rotation zones for a resumptive rotation move. You can see rotation zone, rotation zone, rotation zone, rotation zone, etc. In bear markets, I watch for sells. So we had a sell, and now we're technically back above the new rotation zone on a weekly basis. So here's what I can glean from just this information. I'm technically in neutral mode on a weekly, and we have the bullish mode on the daily. You see, we got the cross of the rotation zone, pull back the rotation zone. This was a sideways move with a rising rotation zone. So now I'm going to be watching for either the breakdown play back into the rotation zone and then a resumptive move up, or a breakout play to the upside. So I can come up with some simple, quick analysis on any market by just putting up my rotation zone and knowing the probabilities.
Awesome. Okay, so So we're going to give the macro look first. So I look at this chart and say that a consolidation above 42.25 would mean it broke from those highs from back early June and was poised to move higher. What would you say about this chart?
Very similar. Right now, we have two concepts, and I'll, again, for a little teaching moment for people wanting to learn at home following the podcast, there's two kinds of corrections. The earlier correction at the end of July, you see this little 3-bar correction. That was a pullback correction into a rotation zone. This is a basing correction, letting the rotation zone catch up. So I call it 8 pushing the price. What does that favor? It statistically favors a breakout to new recent highs, and that would be above also the highs established at the beginning of June.
Got it. Okay, so basically what I'm saying then is you buy it here already, or you wait till it eclipses those highs?
I am waiting for it to eclipse those highs, and this is where I'll bring in other data too to help me fine-tune entry levels. Why am I waiting? Because we are still in a neutral market with still long-term bearish bias, so I'm waiting for additional short-term confirmation in order to get all the probabilities. Also, if you see here, let me expand something at the bottom. On a weekly basis, we are very close to overbought level and pinned at the top for cycles. So we sort of have a mismatch in short and long-term areas. So that's why I'm waiting for the confirmation breakout to the upside. Otherwise, if we break down below about 4,100 on a closing basis, I'm watching for a return pullback into the daily rotation zone before another resumptive move higher.
Okay, that's fascinating. So if you were giving like the time frames on this, like if this is this a medium term, several week trading opportunity, or is it a shorter term day trader?
No, this is a let's go through both the scenarios. And I'm going to give some longer term scenarios too. But I'll have to bring on some additional lines for that. Short term. Did we?
We lost Jimmy. He's fine.
No, I went to get some water. Is all. Can do that, can I?
Water?
Yeah. I don't have any booze in this office.
We'll have to remedy that, won't we?
My wife is waiting for me down at Ceres. And for those of you who don't know Ceres, Ceres is the place where the police chief of Chicago went and had 2 drinks and fell asleep in his car and claimed he took some bad medication. I've had the drinks at Ceres before. They are bad medication, so I can attest the fact that he was telling the truth.
The heaviest pour in the city of Chicago.
Heaviest pour in the city, Ceres at the Board of Trade. If you guys haven't been there before, go. Michael, you're up.
So, in the short term, if we break down below about 40, let's just go conservative on a closing basis of below 4,090. I'm watching for a pullback as low as 4,020 before a resumptive move higher. A close above, let me bring on my other lines now. A close above 4180, 4175. 4175 takes me into the breakout mode, and my target's the upside. I have a minor target, 4221. The next stop reduction target, 4272. And my major targets, because anywhere between these two red lines, 4224 and 4368, I watch for a rollover play. So I have to fine tune it with my shorter term levels. My major levels, coincidentally enough, are some harmonic projection levels with that flat 200 simple moving average right in front of the 62.5% harmonic zone. So my ultimate target is about 4335, 4340 area for at least once we break to the upside.
Okay, Bobby.
Yeah.
We said we're going to pepper some fundamental in with this. When you see this, does a higher than expected print in the CPI? I know we believe, Bobby and I are mostly technical as well for people who's watching, but we do watch fundamentals a little more than Mike does, which I'm not sure if that's, praying at too many altars. But do you believe that headlines will follow, that this means that the CPI number will come in a little more manageable, or does it have to follow?
I think what happens here, and again, I don't necessarily have a trade representing this. I put on a long ES trade 2 podcasts ago, and I'm still in that one. And when I look at this chart, I start to think, and Mike knows this, if I do a TV interview or a podcast or something, my fundamental view is based off what the charts are telling me. So I look at the charts and I say, okay, it looks like this is going to go higher. Why would that happen? Right. And then I kind of craft a fundamental view around that. So I think stocks are going to get, to that 200. And I said this on Bloomberg this morning. I said, we're up about 14.7% or so from those June lows. I think we'll get to 20. Right around the 200 is somewhere around 19 or so. It might be a little bit more than that. Mike can measure it while I'm talking, but from a perspective of how CPI, and then you look to the data next week, which is what you're talking about, right? You say, okay, what data would likely move it up to the 200? Yeah, there it is, 19.5. Okay, perfect. So what data would take you there? Well, it would be a milder CPI, right? And then we have a lot of Fed speak as well. So what would make it fall from there? Well, the Fed's saying that, explaining the base effect to people and explaining that this is still way too high and explaining that they're still going to be aggressive. And then companies saying in future earnings, next week we've got like companies like Disney, companies like Cisco Foods, right? Your sort of regular companies that people used to look at before big tech. And they could start to give guidance and say, our wages are killing us. And then that could make it turn around there. So that'll probably be the fundamental ideas that I'll explore over the weekend and going into next week. I think CPI will probably miss by a couple of tenths, and that'll take stocks
to the
higher.
downside. To the downside.
I think the expectation, I think we looked today, Mike, and the expectation was like 8.7. I could see an 8.6, 8.5 year over year, something like that. And I could see maybe a 10th miss, given just off of commodities having fallen. But then the wage comes back into play, the wages, they keep coming back into play with a wage price spiral. And then you could also have the Fed. I'm talking too much, but yes, that's the answer. I think CPI could be the thing that takes it up there.
Michael, do you have more to add for S&Ps? Because I find the NASDAQ very interesting, because the NASDAQ seems like it's about a week ahead of the S&P, because it's already broke above those June highs. Do you want to move over to that, or do you want to add more to the S&P?
Let me just add a couple things, okay?
Sure.
Because even, let's say we know we have the big CPI number next week, and even if, let's say we did get that short-term sell-off and the break below that 440.90 level I was talking about, it would still be in short-term bullish mode, even on a pullback to 40.20. And I can't get into, again, long-term systematically, we're still in overall bearish mode, but you got to trade with the short to medium-term trends, which are up right now. What doesn't, and I wanted to put this out here because I'm on once a month, but if something disastrous happened, what would, on a closing basis, especially a weekly closing basis, would really start tipping the scales would be a weekly close back below 39.15 area. So I just want to get that out there so people know, because I always feel you have to analyze both sides of the market. Otherwise, you can get caught off guard.
Yeah, and 39.15, one more time, why 39.15?
39.15, let me get back to the chart. That was this major breakout. So we had retested June, retested July, break, retested on a pullback July, and it's also, you're right there, you have a 50% harmonic, so that would wipe out 50% of this up move.
Got it. That makes perfect sense to me. Okay, now this to me is going to be an interesting comparison, because the NASDAQ is above those June highs, like I said. Let's look at this and do an analysis.
All right, so again, we have this was a prime example. This move back at the end of July was a pullback to rotation zone. We've had that sideways basing move and the breakout from the rotation zone. And now even with this, even today, you essentially had the pullback to the top of that breakout pattern. So key things I'm watching for. Should we pull back next week with, who cares what it is, but if it was due to CPI, whatever. The 13,000 is now major support. Why? We have a significant level there. It was a breakout of a key closing and opening basis, and we have the rotation zone right there. You break below that, it's still technically in bullish mode, and I'd be going back closer to 12,700, watching for the bigger pullback before the rotation up. Now, so that's the sort of short-term pullback mode. What tips the scales is roughly about 12,000. Warning sign is 12,002, majors of 12,001 on a closing basis. That tips the scales back to bearish mode should we go into disaster, something disastrous happens. That's the downside case. The upside case, again, we've been basing above these key highs at the beginning of June before the last substantial pullback. We're still, even on that short-term pullback, we'll be basing above there. The next key areas we've just actually rotated off today off a major minor harmonic. The next major areas I'm targeting are 13,540 to 13,628. A close above 13, you can go to 13,630. Next major, remember I talked about that major rotation where I start watching for a major topping pattern. The major topping area so far in the NASDAQ is between 13,903 to 14,636. In between that just happens to be that 200 simple moving average at 14,100. So that's my next major target above 13,900.
That's outstanding. Okay, good. So if you had to break it down in the most simple form, is you're somewhat in bullish mode right now. A close below, what was the level again? 12.1 would put us fully back into the bear market in your mind, correct?
Correct.
And a close above where kickstarts your thinking of when the bullish move begins?
13.4.
Okay, that makes good sense to me. What asset do you want to go to now? I want to do a trade in the micro and the euro, but it's your call as to what asset you think is interesting to move forward to from here.
Hey, real quick, can I ask you guys a favor?
Sure.
A mutual friend of mine and Jimmy's, Asia Hussein, is complaining that we're too serious. So I want us all to smile. I'm going to take a picture of the computer. You ready? Everybody smile. I'm tweeting that out. I'll tag you both.
Serious?
Because we are fun-loving guys. Mike, I've never even seen you smile, by the way. Even when you laugh, it's not with a smile, is it? That's his response.
That's his response right there.
Okay, what are we moving to?
Can we just touch on the notes? And did you want to still go into anything with the yield curve, Bob?
I'd like to talk a little about the yield curve. Sure. You want to put that up,
actually,
Jimmy, because I'd like you to see this. This is something that we talked about on our, I got to smile more. We talked about on our live stream, and we want to talk more about it here with you today, Jimmy. I sound like Mr.
I don't see how anyone could accuse us of being too serious of people. We're usually screwing around. But I think we do have serious looks on our faces. I think that's a short Italian guy thing that we want people to be scared of us ultimately. And even when we're messing around, it's supposed to be like quirky, like, yay, fucking guy, you know, that kind of thing.
All right. So this is something we talked about. So we were watching this.
Two cents?
Yeah. So we were watching this. 2 stands is the one everybody looks at, right, Jimmy? And it's kind of the most predictive. Yeah. It's been right 11 of the last 12 inversions. Don't quote me on that, but that's the last piece of data I saw. Was 11 of the last 12 inversions resulted in recessions. And I'm not saying this drives a recession. I'm just saying it's a predictive thing. And there's been head fakes. I know, for example, the 1998 one was a head fake there. The little tiny blip of an inversion that we have in 98, which you can see on the chart. We didn't have a recession there. But we did have a 1990-91 recession. So there's your inversion. We did have a 2001 recession. We did have a 2008 recession. And we did have a pandemic-induced recession where there was a brief blip, yeah, below. So the horizontal line is 0. So during the course of today, Mike, maybe you can do this while I'm talking. There was a 47 print on the 2s, 10s. Okay.
Negative 47.
Negative 47. So you can see it right there on the 5-minute chart. So if we go back to that long-term chart, we draw a horizontal line at 47, you'll see that the inversion has gotten down to levels that we haven't seen since basically the tech bubble, right?
Wow.
So if you
Well,
draw
I'm
that
putting a line at
horizontal,
46.3. It's close enough.
it's close enough. So
Yeah.
the tech bubble is the last time we had it, and we actually got lower than the 98 inversion. So what I'm wondering is your opinion, Jimmy. Is it the depth of the inversion? Is it the length of the inversion? Because you can see there were blips, or is it just there's a recession, it's predictive, and you have no real feel for it?
Here's what my thumbnail analysis has taught me is that the depth of the inversion predicts the likelihood of the recession. Like, this would be extremely unusual for me to be trading around negative 40 basis points in 2s, 10s and not have a recession within the next quarter, let's say. So the speed it's coming and the likelihood it's coming. I don't necessarily think that the depth of the yield curve predicts the depth of the recession. And I'll go back to, for instance, and again, we are all living in somewhat post-traumatic stress syndrome from the real estate bubble cracking in 2006, 2007. And people have to remember that that was a recession that was going to be miserable because it involved decades of positions being built up in a highly illiquid asset, real estate. Stocks, when stocks get in a bubble, buttons are pressed and the bubble is corrected. It could take months to work your way through all the ancillary effects of that. But the real estate bubble breaking was going to be huge. And remember, that inversion was not that deep. And it was not, it was not nearly as deep as this, correct? It's the one right there that's about negative 20 basis points
Right.
To our negative 40. So
Right.
I don't think that the negative 40 means this is going to be the end of the world recession, because I don't see excesses built up in an illiquid asset that's going to take so much time. Like, you could have said 2 years ago, or even a year ago, people would have said, well, it's a $3 trillion crypto market. When that breaks, it's going to drag everything down with it. Well, guess what? Already broke. Are stocks really in a bubble if they've been trading negative for 7 months? I don't believe that to be true. Is real estate in a bubble? No. Is your plumber brother-in-law still talk about all the 5 homes he owns? No, I don't see that happening. Does that make sense, Bobby?
It does. And maybe Mike can chime in if you'd like, but I think what you're saying, and tell me if I'm I'll say misgendering what you're saying. If I misgender what you're saying here.
That's the drinking word. We should say misgendering from here on out.
So tell me if I'm misgendering what you're saying here. You're saying that the deeper the recession, the higher the probability of a recession, but it gives you no
the deeper
signal.
the inversion, the deeper the inversion.
I'm sorry. The deeper correct. The deeper the inversion, you don't think it necessarily predicts, and I'm going to back you up with a little bit of data. You don't think it predicts that the recession is going to be deep. You just think the probability of there being a recession at all rises higher.
Exactly what I mean.
Okay, good.
Yeah.
So when I was looking at this today, I decided to mark off all the recessions, and really in this particular data set, the longest lasting recession was the 2008 one.
Yeah.
And it actually is the lightest inversion of the major inversions here. Obviously, we had the one in 2020, and then we had the head fake in 1998. But of the major inversions here, of the 4 you can see on this chart, the longest recession was actually the 2008 one. So it kind of plays out to what you're saying there.
Right. That's awesome. Good. Yeah. I like it.
The other thing I want people to watch for, just something that's, once this starts accelerating back towards zero and gets especially above zero, we tend
this is interesting. So I'm sorry, Mike. Say that again, because this is interesting. I did not know this.
Once we start accelerating, once the spread starts accelerating back towards zero, and especially gets back above zero, watch for a continuing sell-off. Okay. And then as it accelerates above, the first warning sign that we could be getting to a major market bottom is when it gets above about 1.5. and I really start watching for a major reversal, and I'm talking weekly reversal patterns, a bear market, major bear market bottoms when it starts getting above between 2 and 2.5%, uninverted.
So interesting. So you think that when we go positive again, that's correlated with more stock market losses? That's what you're saying?
Yes, the
I
bottom's
don't like that. I
not
didn't know
in
that.
yet.
Yeah.
The data shows that is what he's saying. He's not saying he feels
Interesting.
that. He's saying
No,
the
yeah,
research
right.
he did shows that that's typically what happens. Doesn't mean it's going to happen this time.
No,
Of
and
course, that's interesting.
again, nothing's guaranteed, even in technical, especially in technical analysis. Everything is why I talk about probabilities. The probabilities favor. And just because the probability is favor, even if it was 80%, there's a 20% probability something could be wrong.
Got it. That is fascinating to me. That's good.
I didn't know that.
Okay.
I mean, if you see this, I don't know if you can see this orange line here.
Yeah, we can see it.
So here's where it starts accelerating back above zero. Here's where it starts accelerating towards zero. You start getting the sell off, and here's above zero. And as it approaches up around here's that 2%. I don't have it on the scale here, but up around here, and you see it starting to get up in this zone to a bottom. You then have this other area. It starts accelerating. This is from 2008. It starts accelerating back above zero. You start getting a major sell off. You get up into this 2 to 2.5% area. You start getting towards the bottom. Even on that little blip we had back in April where it went below 2 and then accelerated above, you've got that acceleration to the downside. I would not be surprised to see, again, the continuing little recovery. We're, as I call it, we're in the go-go gadget market right now, which is good news, bad news. Bad news is good news. Every news is just let's buy everything, including all the crap out there. So as long as we continue in go-go gadget, we can rally more. But then when this thing eventually starts putting in a bottom and accelerating back towards 1, I'm going to watch for the next major rollover leg down.
Now here's what's interesting. Go ahead.
You go.
I'm sorry.
No, I was going to say this is something this blows me away. This is something that's going to consume a lot of my thoughts over the next weekend. I tell you this,
I got one more thing to add to that, to what Mike just pointed out. So notice the orange line in the 90s, right? The inversion reverses and heads up, but the S&P doesn't move, right?
Okay. Yeah.
There was inflation in the 90s. And this is what I keep talking about. On my screen, I'm looking down at, I've got inflation. Annual inflation, January 1990 was 5.2%. 1992, 3.03%. Even in the 94, it was all well above 2.5%. It started dropping in the late 90s. And look what happened to the equity markets in the late 90s when inflation started to fall off. Now we got another inversion and we got another recession, but we got the typical behavior of the stock market. And this is what I keep telling people. The reason I don't think that the bottom is in is because inflation is here. It's the only difference between this and other. We don't have a recession yet, but if we get a recession at this point, the difference is inflation, which is the difference we had in the 90s as well.
That's fascinating to me. Love it. Okay, what do we want to move to?
Since we're talking about that, let's just go to the 10-year futures real quick, because there's an interesting pattern here. Even on this pullback play, we've now triggered a massive inverse head and shoulders into what I called it, and Bobby calls an advanced clear path move. Now this can pull back. It can even pull back on a closing base. What would invalidate the pattern would be a close below 117 essentially. But this for the next, and this is a weekly pattern that's triggering, so this could take multiple weeks to unfold. But you should still see yields after this next substantial pullback, yields continuing on the 10-year to go down for a series of weeks. The probabilities are there. Now, the probabilities were also there because I talked about this on the YouTube channel that, hey, it hit some key levels. We were watching for the pullbacks because cycles on the daily and the weekly were at the top. So this is not surprising. And then it just accelerated with today's unemployment figures. Could we get a little more acceleration still to the downside in the futures with the next CPI number, but still from a long-term perspective, those are long-term positioning buy opportunities for eventual lower yields and higher note prices.
I will point out to the people watching, these are the 10-year bond futures, which are trade inverse to yields. There's also the micro yield contracts that the CME offers, which are the opposite of this. Trade their yield based in yield and not in price. So this, when they go higher here, yields go lower.
Here's the yield curve or the yield futures.
Oh, right there. Okay.
You can trade the yield futures. On the yield futures, you're trading it as a topping pattern. In the notes, you're trading it as a bottoming pattern.
Got it. Exactly. That's awesome.
Good. Let's just review one more thing real quick, and then we'll get to currencies. Because what's interesting was we also just today, finally something. We triggered a massive double top pattern in crude on a weekly basis. So to tie in, this is actually sort of interesting because if you tie in things, we got the cross of the weekly rotation zone, which has shifted from bullish mode back into bearish mode. We also have a independently triggering massive double top on a weekly basis, which for multiple weeks, and this is a pattern that can play out for weeks, if not months, because some of these weekly patterns can take a long time to unfold. It has lower crude prices. That does not mean we can't have rallies. We cannot have, again, we have to be prepared for some pretty quick upside rallies. But now with these probabilities on multiple things shifting to more of a bearish footing, the rallies are to be sold at key reversal areas instead of trying to just buy dips repeatedly.
So what are we talking about for this break in crude? Because it obviously has lifestyle implications, not just trading implications for a lot of the people who are watching. We're talking about pullback to 70?
First little minor pullback level is 83, but your major first target for the double top is 77.50.
Wow.
That's a stop reduction target.
Yes.
Okay.
That is a stop reduction target, and your first major profit taking target actually is pretty close to a major harmonic level, which is coming in anywhere from, we'll just call it 70 to 71 bucks. That would be
really
nice.
Quick. Explain to people what a stop reduction target is for people who don't know.
A stop reduction target is an area we like to tighten up our stop. So if something unexpected, let's say something unexpected in the world happens and crude rockets back up, we've significantly reduced our risk in the position based off of current trading levels. So we try to, okay, we've hit a key area that if it is going to reverse and something fundamentally shifts again, we want to have eliminated a lot of our risks should it move against us.
I like it a lot. Okay, good. Now can we
fascinating? Yeah, fascinating. One more thing. A weekly 200 simple is a major magnet price. You see, even before it got there, it rose in the August of 21, retested November 21, base there in March of 21. Right now, that's at 61.41. The full target for this double is right at that level. I'm not saying you're going to get there anytime like in the next few weeks, but I'm saying long term, that's my long-term target. It could take months to get there.
Wow.
So this goes to what we talked about earlier, Jim. I did a Bloomberg BNN this morning, and in my notes, I put that my target was in the mid-60s. Now, I know that the actual target was lower, but I wanted to be more right on TV. So I know that if we get to 62, 61.81, then my 64 target, they'll come back and go, you were right about 64. I'm like, I was actually lower than that, but that's okay.
That's all right. At least you had it. It's just funny because some of these knuckleheads will go on TV and make what sounds like a wild claim. Like, yeah, crude's going to 60. I think they just want to gain headlines. When Mike Arnold says it and that it's a possibility, he shows you the data that backs it up. And I think that there's a big difference in that. And I appreciate that very much.
And
Can we
short
move on
term,
to
I'm
currency?
still watching for a short term bounce. So don't be caught off
Sure.
guard with the short term bounce.
Okay. Let's can we
Euro.
finally move to the euro?
Yes, we're here right now.
Okay, good. Yeah. Okay, there's a euro. What do you think?
Weekly, we've returned and tested the weekly rotation zone. You get a close, aggressive close above 103, a conservative close above about 103.50. That leads me short-term bullish mode. What leads me back to bearish mode? Right now, we're in a trading range. Again, we've essentially moved sideways, letting the weekly rotation zone catch up. It still favors a breakdown play, but I need confirmation on a closing basis below 101.50.
Okay, because I'm going to give my trade here, and then we can dissect it. And again, I don't have this trade on. I'm considering putting it on Sunday night. Selling the SEP micro euro at 1.0240 and targeting a move down to 1.0050. Now, I didn't pick that level randomly. I think that if we break down, we make a run for parity. So I wanted to put my take profit above parity, although I think we'll get it if we start to head down there. My stop, I think you're going to like, is at 1.0340. I know you said 50, so maybe I will monkey with it a little bit. But that trade, if it hits, you make 190 bucks. It's $1.25 for one tick in the micro euro. If you loss, you lose 125 bucks. Thoughts?
Go ahead, Mike.
I mean, statistically, with the declining rotation zone, it favors lower prices, and I do like your stop level. One little tip for stop levels: anything with 40s or 80s, and I'm talking about the third decimal place, so point zero, whatever, 0.004 or 0.008. You don't want stops right on those numbers. Those
Why?
are magnet. Those are really magnet numbers for. They've tested out horribly in currencies.
The answer is always the same, Jim. They answered, they tested horribly. That's it.
Yeah, but I need to know why. You know what I mean? Like, it makes no sense. Some things make
Mike,
sense.
do you have the hierarchy of questions handy or no?
We should do that. Next time I'm on, I should put up the
Next
hierarchy.
time, have that
questions.
ready. Mike has a hierarchy of questions for traders. Guess which one is the weakest question? Why?
Why? Right? There is no why. It does not matter. It just tests the way it is.
And can I give you a quick thing? This morning I was talking to people, and they're like, "We're selling it. We're selling the markets," and I'm talking the financial futures. We're selling it, and so I play. Why? Oh, because the employment numbers, the Fed is not going to pivot, so we got to sell it. 30 minutes later, I'm having another conversation after it's rallying off the bottom. Why are you buying it? Because the economy's strong, you dummy. So I get the exact opposite. I mean, why does not matter. It's just like they're going to come up with a reason. Why? Because this. Well, you were selling it for the opposite reason a few minutes ago.
Jim, do you know my Lloyd's of London sushi boy sushi story?
No.
There was a brief period of time where I was in charge of sterling US dollar when I was at a German bank. Okay. The bank, and sterling US dollar was sort of my coverage. And there was a huge move in sterling yen. And there was kind of like a move in sympathy in the sterling dollar, right? So, and there were people screaming in the trading room, Soros is getting involved. The Bank of England is selling sterling, all this crazy stuff, right? And when it was all over, I had a friend at Lloyd's of London that I had actually just been with in London about a week before. And he called me up. He's like, "Man, did you see that move? It was crazy." I go, "Yeah, do you know what it was?" And he goes, "Yeah, there's a big sushi boy chain here in London. They want to expand. So they were selling a bunch of yen for sterling because they need to hire managers and build." Now, what economic conclusion can you garner from sushi boy sushi buying a bunch of sterling? So the funny thing is some of those traders were right and some of them were wrong. And the reason they were right was for sure wrong. They weren't going, "Sushi boy sushi is buying, let's get in." That's not so. That's just an example of why being weak.
That's fantastic. Yeah. So the reason I was mostly want to sell the euro here, when you look at that chart, I believe it's tried a bunch of times. That level, that 103 level, is obviously something that's significant. So that's why I have a weakness bias. The fundamental had something to do with the Fed being emboldened today, and the Bank of England, I know, spoke with quite a bit of bravado, but it's easy to have bravado. Not right now, before the winter months come and energy's so high and their economy could be falling apart in Europe. I know I just conflated England with Europe, but whatever. It's kind of all the same. They trade a lot alike. So I do think that the fundamentals, the fundamental story backs this trade up as well.
I like the trade itself because, again, I think we've got multiple Fed speakers again next week. And I think you'll get to your profit target prior to perhaps a weak CPI weakening the dollar and strengthening the euro. I think you'll get your profit target. And again, we could have a strong CPI and it could embolden, and that'll really get you to your target. You'll want to hurry up and get your take profit trade out of the market to get, to get some excess in the trade. But I like this trade in the short to medium term, and that's what we're talking about here. I like it a lot.
Good. We have about 5 minutes left. Can we do metals?
You want to do precious?
Yeah, I like it because I think I wasn't watching it too closely, but I thought gold bounced off a level that I thought was significant a couple days ago, and I want to see what Mike's take is, if that's cool.
Yeah, we bounced off of we call this the breakdown zone. I'll just put a line there right here, and everybody can see it. Breakdown zone. That was support, broke down and retested that key area right there. So we bounced off of that on the short term.
Tell me this.
What was that?
Yeah, that looks weak to me then, right?
This has already been weakened. So a move back above of 1810 is a breakout play. So this is that attorney. I'm watching for a more substantial, I've been talking about this on our YouTube channel for a while, a substantial low being put in. It's either we get the breakout play on a close above 1810, which is then I will target a major harmonic area about 1873 to 1880 will be the overall, with the stop reduction at 1841. If we don't get the breakout play, the only thing I'm watching is we have a little shorter term potential double top, which would, remember, we had a breakaway gap back between the 27th and the back from the close on the 27th. If we triggered that double top, which would be on a closing basis back below 1778, I'm watching for the pullback, and actually the double top target is essentially the gap fill target back to my major longer term reversal zone for a bullish play, and then I will watch for a bullish entry back there. So it's either trigger the breakdown to get back to a bullish entry or the breakout play.
And looking at both those charts, that series of charts, particularly that one, is the higher probability lower from here since it turned around right at that level, or is it 50-50 in your mind?
It's we don't have the double confirmed or triggered. We have the rotation zone rising. So this is challenging because I would have to agree with you. I don't have the exact numbers with this but it's closer to 50-50. Why? We're against key resistance in the weekly rotation zone, but we're getting that bottoming formation with the daily rotation zone coming up to push up the price. So I would naturally favor the breakout play, but I'm prepared for either. It's sit on my hands until one or the other triggers. And if the bearish play triggers, it's a short-term bearish play for the double top and the gap fill.
And if the long one triggers, it's more of a substantial move higher.
Then it's a breakout play, which would then we would have a very minor pullback, a shallow pullback that couldn't even dip below the 25% harmonic, which in our testing is a very shallow pullback with the rising rotation zone. So yes, it does favor a fairly strong break to the upside.
Okay, can we take a glance at silver too and see if there's anything different?
We can sure glance at silver. Silver does not have a this is a very messy you almost had a double within a double right there. So not really playing that as a double. The key area I am watching on silver on a pullback. I was watching, we broke down pretty substantially, but we bounced back. So if we trade back below on a closing basis about 1956, we still have a gap left behind. But what's interesting is my go-to play first is gold over silver, because we pull back here, we could still retest this low area before with a breakdown play. Now the breakout level for silver is on a close above 2050, and then a stop reduction, which the concept we've already touched on before, is 21 to 2106, and then a major target area is 22 to 2204.
Fantastic. Okay, that's awesome. Bobby, is there anything else you want to cover? Can I get back down to my wife at series before she has her second
No,
drink?
I'm good. I want to do one more thing though, if you could.
Sure.
If we could, Mike, can you just pull up the picture of the yield curve again and put the overlay of the S&P? Because I want to take a picture of a screenshot of the three of us looking at that and make it so that people can, I want to put up on Twitter and say, hey, Mike explains why this matters.
Oh, yeah, that's good.
If I could just have you on here at the same time, the thing is going to be somewhat like something to the effect of, and Nader, can you cut all this out, please?
Why though? I don't think we need to cut all this out. I think the people who listen to us like to hear how we talk. I think it's fine.
Right.
But anyway, that's just
fine. Basically, the tweet is going to be, so if you're watching this later, the tweet is going to be, do you know what this chart means? Mike Arnold explains it. Keep as much of 98 in there as you can, Mikey. Oh, that's perfect. The other one was perfect. Yeah, right there. Because that shows how the S&P doesn't run up in 98, but does in the other areas.
This is a wild chart to me. I think this is amazing. Yeah.
All right, I got it. I
All
got
right.
it.
You know how the dealers leave in Vegas, right? I got to go. See you, boys. This was fun.
See you doing. Thanks, Mike.
Yeah.